The live stock price for Nuvve Holding Corp, NASDAQ NVVE, is currently $0.16, reflecting a modest decrease of negative 0.0059 or about negative 3.56% in the last reported closing or pre-market trading session. Given the immense volatility this stock has shown, especially recently, as it trades well under the $1 minimum required for continued NASDAQ compliance, this minor intraday dip is practically a whisper before what could be a Category 5 storm. The real story here, the angle few investors are truly paying enough attention to, isn't the current price or the routine downward pressure. It's the quiet, yet strategically critical international agreements that Nuvve is stitching together, particularly its recent move in Japan. They just secured the country's first aggregation agreement for existing stationary storage batteries, which, though not directly related to their core vehicle-to-grid V2G platform, is a significant foothold into a high-value, highly regulated energy market. This suggests a strategic pivot, or at minimum, a major expansion of their addressable market beyond the immediate cash-intensive world of fleet V2G implementation. And that's a detail that should make everyone who has written this stock off pause and take a closer look at the big picture. The common market expectation, based purely on the stock's harrowing technical picture, trading in the sub-dollar range, facing a NASDAQ delisting threat, and seeing its 52-week high of over $5 now feel like a distant memory, is that this is a financially troubled company clinging to life, another casualty in the high-burn, capital-intensive clean energy sector. Most individual investors and even institutional players using platforms like Fidelity, Interactive Brokers, or those who prefer the simplicity of Robinhood for trading volatile stocks look at the plummeting share price and the low institutional ownership, currently around a slim 1.73% of shares outstanding, and simply categorize NVVE as a high-risk microcap on its last legs. The general belief is that the high promise of V2G, which is essentially turning electric vehicles into mobile batteries that can feed energy back into the grid for compensation, has simply been too slow to materialize financially, leaving Nuvve's balance sheet exposed. The reality, however, is a classic tension between a deteriorating financial statement and a legitimate, high-potential technology with growing global adoption. The recent Danish agreement for new battery energy storage projects, adding 6 megawatts of capacity, and the Japanese aggregation deal both point to a technological viability that the stock price completely discounts. They are quietly building out real-world applications and geographical diversity that can act as revenue pillars, insulating them somewhat from the notoriously slow, red-tape-heavy U.S. fleet electrification projects. These projects, especially the one in Japan, demonstrate the company's platform's capacity to manage non-EV assets for grid stability, which is a major expansion of their core competence and a much-needed diversification from relying solely on Tesla stock or other EV fleets adopting their V2G tech. Focusing on the recent movement, the immediate pressure on Nuvve stock is, of course, the looming Q3 earnings call scheduled for aftermarket close today, November 13, 2025. This event is the single most important near-term catalyst, or perhaps a further blow. The market is positioned for disappointment given the company's past performance and the general narrative surrounding small-cap, pre-profitability energy tech. Volume has been erratic, a hallmark of low-float, highly speculative trading, seeing bursts related to recent news, like the announcement of the Danish and Japanese contracts, followed by sharp pullbacks as traders take profits or long-term holders finally capitulate due to the delisting fear. This low price point, however, means that any material positive news or even a strategic financial update that mitigates the delisting risk could trigger a sharp, outsized short-term rally. The institutional activity, though low in total share count, shows an interesting mix of new small positions from firms like PFG Investments and Virtu Financial, alongside significant large-scale exits from other funds over the last few quarters. This suggests a deep division in how sophisticated players view the company, either a worthless lottery ticket or a deep value play waiting for the regulatory or strategic inflection point. For an individual choosing to self-invest through an individual brokerage like SoFi Invest, or considering a platform like Schwab Intelligent Portfolios for broader exposure, NUV represents the extreme end of risk-reward, completely unlike the relative stability of an Apple stock or a large ETF tracked by Fidelity ETFs. The company's core business model is centered on its proprietary GIVE platform, a cloud-based aggregation and control system that manages the flow of energy between electric vehicle batteries and the utility grid. This vehicle-to-grid, or V2G technology, is what NUV is known for. The platform is designed to charge EVs when energy costs are low or renewable energy is abundant, and then intelligently discharge electricity back into the grid during peak demand times, for which the vehicle owner or fleet operator is compensated. This is a crucial function for grid modernization, especially as jurisdictions aim for higher renewable energy penetration, where intermittent sources like solar and wind require massive, flexible storage solutions. Their primary target is commercial and school bus fleets, as these vehicles have large batteries and predictable usage patterns, making them ideal for grid services. Past performance, however, has been marred by slow project execution and significant cash burn, typical for companies that are simultaneously building out infrastructure, developing software, and navigating complex regulatory hurdles in multiple international markets. For instance, their Q2 2025 results saw total revenue decline significantly year over year, and the net loss widened substantially. The high products and services margin they reported, though positive on its face, was mainly due to a lower mix of hardware sales and a higher mix of engineering services, which is less scalable than a growing hardware and subscription base. Their customer backlog of around $20 million, while indicating demand, has been slow to translate into recognized revenue, which is a major source of the market skepticism. The recent sale of their minority stake in Drivsauce for €800,000, while a small cash injection, signals a needed effort to rationalize non-core assets and shore up the balance sheet. Looking ahead, the future outlook for NUV is a story of high-potential technology meeting acute financial instability. There are two critical catalysts. The first is, of course, the outcome of the Q3 earnings call and the subsequent guidance. The market is not just looking for revenue figures, they are scrutinizing the cash burn rate and any specific, concrete updates on the ongoing appeal process to maintain their NASDAQ listing. A positive update on the latter, perhaps an extended deadline, or a strategic plan involving a reverse stock split, which shareholders have already approved the board to execute, at their discretion, at a ratio up to 1:40, would be a lifeline, dramatically exceeding the current low expectations. If they announce strong revenue conversion from their existing backlog, or even more importantly, a large, new, immediately revenue-generating contract that capitalizes on government funding for fleet electrification, it would fundamentally alter the investment thesis. The second catalyst is the continued global expansion, such as the Japanese and Danish projects. These moves show a clear strategy to diversify revenue streams away from solely V2G and into broader distributed energy investment, using their core platform for aggregation of stationary storage. This kind of platform scalability is the ultimate goal for any software-centric energy player. And it's what separates a niche hardware supplier from a technology giant like NVIDIA stock or a global platform like Apple stock that dominates its respective ecosystem. If they can demonstrate that their GIVE platform is truly a distributed energy operating system and not just a V2G controller, the potential valuation upside is huge. The risks, though, are glaring. The NASDAQ delisting remains a substantial, existential threat. Being relegated to the OTC markets would severely limit institutional interest and retail trading on platforms like Robinhood, where access is often restricted, putting massive selling pressure on the stock. They also face intense competition from charging networks like ChargePoint and energy management firms, all of whom are vying for the same federal and commercial contracts. Furthermore, the capital requirement to scale the V2G business, integrating with different vehicle manufacturers like Tesla stock and different grid operators, is immense, meaning continuous need for dilutive financing, which has hammered the stock price for years. For investors who manage their own accounts using an interactive broker's trading platform or similar self-directed tools, the risk of a total loss of investment capital here is very real. Conversely, those who see the necessity of V2G technology for the future of renewable energy and believe in the underlying platform might view this depressed price as a generational buying opportunity, particularly if they believe management can pull off a financial stabilization. The tension is palpable, a potentially transformative, complex